Hey there, everyone. Happy Tuesday, April 7th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a beautifully sunny Redmond, Washington. Hope you guys are all doing well today. No wrestling fan. I will not say Michigan is the best school in the Big Ten, not even close, but I will acknowledge that they did manage to win the NCAA tournament. Congratulations on that. You can stop posting hashtag Go Blue in the chat anytime you want because I am not on board with that. But congrats, nice win. Good to see the Big Ten on the top as always. Welcome to the show, everyone. Thanks so much for joining us here. We're going to do a quick market recap. We're going to talk about the heat map and look at some sector and group themes. We're going to talk about some charts that I've hand selected. If there's a general summary of what happened today, sort of a quiet session as everyone's sort of hanging on and looking for the latest news relative to the Middle East. As you probably have not missed by now, there was a deadline set for the end of the day today, Eastern time. And it looked like toward the end of the equity trading session, there was an expectation of some sort of ceasefire, some sort of extension on that deadline. As a result, we saw yet again what's going to happen when this conflict is wound down. So we've had a couple sort of, hints that the conflict might be near an end. Think about what happened, and that'll give you a sense of what's probably going to happen when things are finally wound down. Stocks rallied pretty aggressively in the last hour. That's number one. Gold rallied as well, along with stocks. So gold moving to the upside. Interest rates pushing lower. Crude oil pushing lower. The US dollar pushing lower. So a lot of those trends have been reversed here in March going into April as events in the Middle East have erupted, with crude oil, extending its move, gold and stocks coming off, rates pushing higher, the dollar pushing higher. Now we're getting a sense of what the end of that conflict could look like. The question, though, and this is the open question that none of us know, is when the conflict is actually wound down. And there's a big difference, I think, in terms of the vernacular we're hearing, the announcements, the posts that we're seeing versus the actual, reality of what's happening. And so I think for now, everyone's going to be hanging on any updates that we can. But if there is some sort of extension to this deadline that was set for later today, that probably means those sort of patterns probably continue through the course of this week. Now, that's sort of the news right now because there's not a lot of earnings. What you have to remember is toward the end of the week, we've got some inflation data. There's a little bit of that today with the I forget what the economic reading was today. I'm blanking something, but one of the minor economic reports. With economic data, you have kind of the big ones like CPI that everyone pays attention to. Then you got a bunch of other ones like the Fed Beige Book, which some people that are really into economics kind of read and dig into specific nuances, but those are not kind of the big market moving ones. Thursday and Friday, we've got the PCE and the CPI. Those are two big ones, Thursday and Friday of this week. With that in mind, let's talk about what's happening here today. So here's what the S&P looked like. We had a weaker open, really had a kind of a quiet afternoon. And then the last hour of trading, as some of these rumors started to come out, the market spiked to the upside. So the S&P did manage to finish briefly into the green, not by much, 5 points higher. So that's 66.17 or so. The Dow ended up slightly lower, although it also had a rally in the last hour. And the Nasdaq went slightly positive at the end of the day as well. So, without that late innings surge, this would have been sort of a quiet down day, small percentage loss day for the major averages. That last hour push higher basically made the indexes flat for the day relative to Monday's close. Mid caps and small caps all finishing in the green, which is good, but not by much. This is a pretty low volatility day in terms of directional move from Monday to Tuesday, although it was kind of a choppy session. And that choppiness, I think, picked up on by the VIX, which did get as high as 28. It did close higher, just below 26. In the last hour, as stocks rallied, volatility came down. So we were finishing at the highs of the day. But then the last hour, we saw volatility come down, still elevated and still higher than yesterday. So out of all the things to be concerned about, right, if you're looking for evidence to still, I think that validates sort of a cautious risk-off kind of vibe, I would say volatility remaining elevated, volatility remaining above 20, just isn't kind of the, bullish reading you probably want. VIX below 20 is what a nice, strong kind of, low worry, low anxiety uptrend would look like. We're sort of in the higher anxiety, higher uncertainty, higher fear range, with the VIX remaining higher, about 1.6 VIX points higher today. By the way, I'm fighting something. So I'm honestly, to be completely honest with you, I know I've been talking about the money show. I don't know if I'm going to be able to make this trip because my whole family is sick, and I thought I was going to get through without sort of experiencing it myself, but it looks like I'm picking it up. So I'm trying to take vitamin C and do herbal tea and do all the things that I can, and as much medicine as I can pack in and still be coherent. So fingers crossed, folks. But thanks for hanging in with me. If my voice craps out suddenly, I am speaking a couple steps lower than normal here. Rates generally moved a little bit higher. Now, they had been a lot higher. They actually came off through the course of the day, and in the last hour, we can see that the 10-year yield coming down a bit. And so that's been one of the key, again, thinking of this combination of factors, right? I think we know what the post-war event looks like. I mean, in terms of market reaction, I think we're getting some clear indications. And so lower rates seem to be a part of that. Stronger bond prices. The TLT, for what it's worth, was essentially flat for the day. Although it had been a lot weaker earlier in the day, sort of rallied in the afternoon along with stocks. But rates lower, dollar lower, certainly in the last hour. And that dollar index, by the way, this is the UUP, which is a dollar ETF, but the dollar index kind of fighting that 100 level, and that's sort of a level of parity that we often read into. Mixed results of sorts in the commodity space. Gold opened weaker but finished stronger. Silver actually opened weaker and finished stronger as well, but didn't quite above the zero line. So silver slightly lower from yesterday's close. Copper prices lower, but gold continuing higher. Gold is really in that kind of okay range. It's really sort of in wait and see mode, and I think that's what we're seeing with a lot of the charts here. Right, the S&P had that big drawdown earlier in March, and now has bounced and now testing the 200-day gold. And silver had big drawdowns, now kind of chopping around, backing and filling. So we often think of a market trend as either a directional move, which is I would say a clear sign of accumulation or distribution, or it's in kind of backing and filling mood, some sort of a consolidation. And that's what I think we're seeing with the charts of gold and silver. Arguably, that's what we're seeing with the chart of the S&P 500. Crude oil prices did go lower, and that drop that you see on the USO, which is a crude oil ETF, is what I alluded to earlier. On a hint that the conflict might be nearing its completion, crude oil prices dropped pretty quickly. And all that confirms is, yeah, crude oil prices are pretty elevated given the threat to supplies in the Middle East, and if that would be alleviated, and if there would be some path forward where that supply is going to be less threatened, crude oil prices would definitely come down. For now, remaining fairly elevated after that drop at the end of the day. Cryptocurrencies all in the green, sort of accelerating higher in the equity trading session. Bitcoin is currently just below 70K. Big round numbers tend to be important. Actually, yesterday on the last 24-hour period, we stalled out right around 70K before rotating lower. But we'll see if Bitcoin's able to pop higher. 75,000 is the real level that we're watching on the chart of Bitcoin. We're not there yet, but we keep a wary eye on those levels for sure. All right, looking at the 11 S&P sectors, very much as neutral as I could script this out. You've got financials literally unchanged from yesterday's close. You have 5 sectors higher, led by energy, technology, and utilities. You have 5 sectors down on the day, starting with the consumer sectors, consumer staples, and consumer discretionary, and the materials. So consumer sectors tending to move together here recently, which is sort of different, right? A lot of times you have kind of an inverse correlation, right? Where it's offense versus defense. Here we actually have the two sides of the consumer space kind of moving along with one another. So both strong on some days, today both weaker. Consumer staples, the worst sector, down 1.7%. Consumer discretionary down 1.2%. Materials and industrials are basically slightly lower. So from the sector side, some observations here. Obviously, energy stocks moving higher. That's again, driven generally by crude oil prices. They came off a bit at the end of the day, but still, best sector year to date. Technology continues to, I think, differentiate itself versus communication services and consumer discretionary. And what you see today with tech up 0.5%, communication services flat, and consumer discretionary down. That's what the relative performance has done over the last couple weeks. We've seen technology outperform. We've seen communications basically in line with the market, a market performer, and we're seeing consumer discretionary underperform. So the three growth sectors are actually starting to be differentiated a little bit. And technology is certainly the positive outlier, consumer discretionary, the negative outlier. Tesla not looking particularly good is a part of that, but it's not just Tesla. There's a number of consumer discretionary stocks on the struggle bus here. Looking at the breadth data, we can see more stocks down than up, although it wasn't huge, but it was meaningful, right? So technically neutral, but a lot more stocks down than up, I would say generally. On New York Composite Index, 52% decliners versus 45% advancers. Even worse on the S&P with 59% down and 41% up. So that's not great breadth, right? I mean, that's pretty rough. But look at the difference between large caps, where decliners outnumbered advancers, versus small caps, where 60%, 59% of the small cap index were up, while only 40% were down. So better day for small caps than large caps, even though the overall returns for the day were not that, were not that much better for the small cap and mid cap indexes. The breadth says this was a much better day in the small cap space than in the large cap space. That's one of the benefits of looking at the breadth data for sure. All right, let's focus in on some key growth stocks and what they're telling us. Broadcom having a monster day, up 6.2%. The chart, I would argue, has not changed a ton, though. This is the problem with volatile, growthy stuff, is that they can have big moves, and it still doesn't change the technical picture a ton, although it is something to note. And I'll show you the chart of Broadcom here in a little while. We can talk about what today's move may mean. Alphabet, number 2, up 1.8%. The rest of this basket sort of flat to slightly lower. Apple having the worst day, down 2.1%. I meant to grab the chart of Apple, and I don't think I did, so I'm going to try to grab that one here if I can remember. And Tesla just continuing to underwhelm. And so the chart of Tesla kind of continuing to accelerate lower. We talked about that level of 385. We broke below, retested the 200-day, broke down, retested the breakdown point, rotating lower yet again. All right, here's your candle quiz of the day, maybe the first one. What do we got here? This one's a little obscure, so take a second here. And I would say the key here with this particular pattern is that the open and close are very, very close to one another. I would say almost identical. So it's that is a meaningful part of this particular candle. Any guesses on what this candle pattern is? So we have the open and close are the same. We have limited upper shadow and a long lower shadow. So if you know your candle patterns, when the open and close are at an identical level, looks kind of like a cross on the chart. That's a type of doji candle, D-O-J-I. That's what that's called. So if nothing else, it's called a doji candle, and that just usually means indecision or a little bit of a short-term reversal. Anytime you see that cross on the chart, like here's an example of a doji candle. So you have a downtrend. The doji suggests, all right, that downtrend probably turns into a reversal higher. We got up to this doji, we rotated lower. This is why people pay attention to them. This, Larry, well done with the candle patterns. You're the candle expert as far as I can tell in Market Misbehavior Nation. The Dragonfly doji, where the open and close are almost identical. They're near the upper end of the day. You have a long lower shadow. If it's the opposite, if the open and close are near the lows of the day, that's called a gravestone doji. I love the colorful visual names to some of these patterns. So for what it's worth, Dragonfly doji, short-term reversal suggests maybe a short-term bounce over the next 1 to 3 bars. That's what the chart of Tesla's telling me. But other than that, that's the only thing that looks good on that chart. That generally we keep making lower lows and lower highs. So a counter trend rally potentially comes next based on that candle pattern. Let's bring up the chart of Apple here. I'm just kind of going off script, but that's what I'm feeling, so we'll do it. Here's the chart of Apple. So Apple was an interesting day here, right? It closed down 2%. It actually traded below the 200-day moving average, but closed back above it. So it probably is a bit of a hammer candle, but it's not a great example because the head of that hammer is a little too big than what you'd normally consider okay. But it was, I would say, again, regardless of how you label it, I would say that short-term move means something, right? So we have a couple days here where we've traded below the 200-day and then closed back above it. That's a common, move that indicates some buyers are coming in, right? So think about it, right? We open here, we trade below the 200-day, but someone's coming in and buying in on that weakness, and so that accumulation, that short-term demand implies that there's some optimism. So we've had a couple tests of that like 245 range, a couple tests of the 200-day moving average. These keep being bought. So that's good, right? That tells you there's confirmed support, as we've talked about here in this range. The downside of that is if and when that breaks, right? If buyers are no longer coming in, that's when a breakdown in Apple becomes very obvious. So the good news about this sort of pattern is we've got a clear expectation of support. If you're taking a position, I think you got a pretty clear idea of where a stop would be a reasonably placed stop, because we got some recent lows where the market has held. But it also means a break below that would be, pretty much the chart of Apple blowing up. For now, not blowing up, it's holding, and I think that's encouraging. All right, let's look at the heat map, shall we? The point of this visualization is to look at what's happening in a visually rich methodology, which is called the market carpet on stock charts. I love this kind of visualization that allows you to kind of assess overall conditions. We kind of do three things here. Number one, take a big deep breath and a big step back. What did the day look like when you look at 500 colored boxes, which represent 500 individual names? Step two, we start to look for sector themes and think about how different sectors were performing and if there are any specific narratives to be aware of. Then we start looking at individual names that have significant moves and thinking about what we can take away from that, right? Where are the opportunities going to emerge? So I don't know about you, but I mean, generally, this is a very neutral look to the market carpet. We can see some things were up. We can see some things were down. I would say the average color feels kind of dead neutral to me. But there were some meaningful moves to the upside and the downside. So initial take is this was a pretty neutral day for the benchmarks. My eyes, I don't know about you, my eyes are immediately drawn to the two consumer sectors, right? Because there's a lot of red in both of those. In the consumer discretionary sector, as I mentioned, it's not just like Tesla that's struggling, because the XLY has not been doing particularly well. And on a relative basis over the last couple of weeks, it's been underperforming by a pretty decent clip. Tesla is a great example of how the sector has struggled so far in 2026. Amazon also has struggled, but starting to find its footing, right? So the big difference between the chart of Amazon and the chart of Tesla, I think that's important to think about, right? Amazon, we've established a low right around 200, 197 or so. We've retested that level now. So we have a couple tests of that 200 level. We've got an idea of where support is, right? Similar to the chart of Apple, we now established support. We have seen on the chart a place where buyers start to come in. That gives us at least something to start with when we try to frame out risk versus reward. If I'm taking a position, what's my downside potential, right? Would be retesting the lows, because anything below that, I'm probably going to want to get out of the way. So am I excited to play upside, knowing that that's the cap to my downside? Like that's how you would kind of think about that. Compare that to the chart of Tesla, which is just accelerating lower. We had support that is no longer holding. We had the 200-day that's no longer holding. So the difference between those two charts is one of them has established a clear level of support and the other has not. And that's why Amazon, from a technical perspective, I would say much better than Tesla at this point. But if you look around, you have Home Depot making a new 3-month low this month. We've got Nike, right, accelerating to the downside. And these are like some of the larger names within the sector. What's interesting to me, though, is within that same sector, with Tesla looking bad, with Nike breaking down, with Home Depot making new lows, you have some of the clothing, apparel retailers like TJX, like Ross Stores, ROST. These are in strong primary uptrends. And, TJX, for example, pulling back today, but this is still a stock making higher highs and higher lows. Now we have a clear level of resistance, but we're still above the 50 and 200-day moving averages, which is pretty rare in the consumer discretionary sector. So this is one of those where I think if you really want to have exposure in the consumer space, there are some charts that look a lot better than others, and I would generally be looking at those, of course. Walmart is the biggest name in the consumer staples sector. Consumer staples generally had a rough day as well. The big box retailers have been some of the stronger charts in there. Costco has been one of the better examples, getting back above 1,000, as we covered earlier this last week. Then we talked about that. Walmart now struggling a bit on the short term, right? We're seeing, we sort of pulled back. We have this, it's not a perfect like bull flag pattern. It looks kind of like that one. We're starting to rotate higher today, a big shift as we go back below the 50-day moving average. The problem now is we're making lower lows and we're failing to make a higher high. So, I mean, this is more, I mean, it's really neutral at this point, but it's more negative than positive. With a chart like this, by the way, that's kind of chopping around, I automatically glance to the momentum. And if you look, the RSI here is between 40 and 60. It's really like a neutral momentum. And the way RSI is calculated, it's the ratio of the up days to the down days. So if the RSI is right around 50, that just basically means buyers and sellers are in equilibrium. That's what it's implying, right? We've sort of agreed on a general value for this stock, which is around 120, 125 or so. But what we look for is which way that momentum breaks. A breakout on stronger momentum, super bullish. A breakdown on stronger negative momentum, super bearish. And until then, it's more consolidating. So we're kind of hugging the 50-day. We're really in a sideways trajectory over the last 6 weeks. I think Walmart at this point is kind of neutral, but certainly something to keep watching. Anything else on the heat map? Yeah, I dug in a little deeply to the consumer space within consumer communication services, noting that Alphabet, continuing to be one of the more interesting names within the communication services sector, and certainly within the Magnificent Seven. Big jump higher for United Health, Humana, CVS, some of these healthcare providers. I did grab a couple of those charts. There's news about Medicaid, I want to say, that caused all of those to jump higher today. We'll look at the implications from a technical perspective. And then technology continues to be all over the place. Keeping an eye on Seagate, making a new swing high here. I did update that chart today. We had a candle pattern yesterday, but actually had a nice follow-through day to the upside, which I think is pretty encouraging. Intel also breaking higher. Palo Alto, pretty close. I mean, it's not quite there to a great chart, but I think that 170 level is kind of right where we're at. So we've had a couple, we've had this sort of double bottom pattern around 140, 145. We're now bouncing back to retest the upper end, a breakout on stronger momentum. We're almost there where that looks like a really good breakout chart, but not quite there. We'll see if we can get it done here. All right, we'll continue on talking about some charts that I've hand selected. Do want to give a quick shout out to our friends at EPS Momentum. If you go to marketmisbehavior.com/EPS, you can learn about their platform. Basically, they have earnings models. They have price momentum models. I am a big fan, as you probably know if you followed my work, of analyzing charts. For me, at the end of the day, that is the core of my process. But that does not mean I don't see the value in quantitative approaches that help me filter through thousands of stocks, tell me figure out which are the ones that may present a great opportunity here. EPS Momentum is part of that toolkit to help me think about price and earnings momentum. If you go to marketmisbehavior.com/EPS, you can get 30% off a new subscription. Check it out. And I appreciate EPS Momentum being supporters of the channel. All right, let's continue on here, looking at the daily chart of the S&P 500. So the daily chart of the S&P 500 looked pretty dire earlier in the day. We had a weaker open, and then we traded lower. And at one point, we were dipping below 65.50, and I'm thinking, ooh, this could be back to the red light era. But the nice rally in the last hour, and really the afternoon, got us back up above that 65.50 level. So I think that's an encouraging finish to the day. Of course, this tells you how much of this market regime is driven by expectations about this conflict. And I think investors are starting to recognize what a lot of the guests on my podcast have been talking about, a lot of talking heads have been, pondering about, which is, this pressure on crude oil prices. Even though the U.S. is energy independent, higher crude oil prices have a ton of ripple effects. And a number of the recent episodes of my podcast have dealt with that. Most recently, I had... who did I have? I should know guess off the top of my head. Ross. I was going to say it's not Ross Mayfield from Baird. Ross, I'm so sorry. I kept wanting to call you Russ there. Ross Mayfield from Baird. Great macro discussion. He talked all about crude oil prices and just what that means and the ripple effects. It was a really interesting conversation. I'd encourage you to check out that episode of the podcast. And I think we're seeing what's happening, right? When there's pressure on crude oil prices, risk assets are selling off, particularly stocks, and in this case, gold, are both rotating lower. Rates are going higher. Crude oil prices, of course, are going higher. Also means a weaker dollar. The idea that the conflict might be over is causing a complete reversal of those things. That's why we're seeing a nice counter trend rally in stocks. This is why we're seeing a bit of a counter trend rally in gold popping higher. The question is there enough of a resolution? Is it actually happening and not just talking about it might be happening? And I think that's going to be the problem. The real question, though, I would say, is when earnings start to come out. I think this Q1 earnings season, which is going to start next week, could be pretty key. We're going to get this toward the end of the week when we got CPI that may start to reflect impact of higher crude oil prices. We'll see what this means for companies and guidance and expectation for future earnings. When it starts to hit earnings, that's when the stock market could go down a lot more. For now, it's just kind of speculation. It's headline driven. If it's earnings driven, right? If earnings start to be dialed down because of potential impact of these macro forces, that's when we can start to get a lot more concerned, I would say. All right, breadth check. We've got percent of stocks above their 50-day. It actually pulled back a little bit today because, as I mentioned, the breadth was not as great as you might have wanted. So we're down to 31% of stocks above their 50-day. That's still better than it was about a week ago when we were down to 20%. And getting back above 30% is pretty encouraging. We're still right at 50% of stocks above their 200-day. I would need to see that get much above the 50% level to feel more constructive about this market from a breadth side. All the breadth improvement that we've seen has been short-term breadth readings like the McClellan oscillator. These are short-term readings that signal, a short-term reversal. The long-term breadth readings, I would argue, still are not particularly strong at this moment. So for now, breadth, I would argue on the charts that mean something to me, not super supportive yet of this rally. New highs and new lows. I don't feature this chart a ton. And what's happened is, right, if you look at what happened in January, a ton of new highs. And this is the New York Stock Exchange in the middle panel. The bottom panel is the S&P 500. And then this panel is the difference, the net difference between new 52-week highs and new 52-week lows, right? So here in green are the number of stocks making new highs. In red, the number of stocks making new lows on the New York Stock Exchange. At the bottom on the S&P 500, this middle panel here is doing the difference, the one versus the other. So what we'd want to see in a bull market phase is a lot more green than red on both of these, which we did all through January and we did all through February. We want to see this being net positive because we want a lot more new highs than new lows. In any environment, even when the S&P is making new highs, some stock somewhere is probably making a new 52-week low. And even when we're in a dire straits and the market's going lower, there are some stocks somewhere making new 52-week highs. So here we're looking at the difference. And so what happened in March is we went net negative because we had a lot more new lows than new highs, but not by a ton. To be honest with you, this whole reading over the last week has kind of dried up because a lot of things were making new 52-week highs in January and February and then kind of pulled back from those highs in March, and they've not regained the new 52-week highs yet. So these are all stocks that were driving the market higher and now are pausing and retracing to some degree. We've had a decent number of stocks making new lows, but there's no real change, right? So we just have a lot less new highs and about the same number of new lows. So the reason why this is important is, what does a bullish resolution to the current phase look like? Well, this is pretty neutral because we got a small number of new highs and a small number of new lows. It's net negative because we have more lows than highs. We would want to see more new highs than new lows. We want to get back to like this kind of pattern from December or January or February. We want to get to this pattern where a bunch of stocks, those early leadership names, are making a new 52-week high. So a lot of times what happens if this kind of market is in a pullback and then it starts to improve, you're going to have those early leaders that, even though the S&P and the NASDAQ are still kind of below their 52-week high, you have a bunch of other things that are actually already starting to go higher, those emerging leaders. That's what we've been looking for. And that's why this chart can be helpful to see if some of those emerging leaders are popping up? Do we see some random names like the Ross Stores and TJX kind of charts, resuming an uptrend and making new highs? That's what we need to see, more and more of those, if you want to be confident about the major averages moving higher. All right, as we mentioned, dollar weaker going into the close, crude oil prices weaker going into the close, gold prices higher going into the close. Gold just about $4,700 an ounce here, which is for now a nice bounce off of a low around 4,100 just a couple weeks ago. So there was that sell off in early March as stocks sold off as well. Now we're seeing this counter trend bounce. 4,800 is short-term level of resistance to watch on spot gold, and the GLD has a similar level on that recent swing highs. I think gold pushing above 4,800 would be a pretty important breakout. Of course, crude oil is very headline driven at this particular moment. Generally, right, if you take a big step back from your monitor, that chart's still going up, right? We still made we're making a new swing high here as we speak. Dollar really has stalled out. If you see, there's a bunch of bearish candle patterns here as we push above 100 a couple times. In March, we had a higher day and then a down day. That's called the dark cloud cover candle. We had a higher day and a down day. That's a bearish engulfing pattern. So when you have these frequent bearish candle patterns as we attempt to break above resistance, I think that tells you about sort of the underlying weakness as we attempt to get above 100. So definitely some macro themes to watch as we all sort of follow the headlines today and in the coming days and weeks for sure. Broadcom, one of the biggest moves in the technology sector, one of the top moves in the S&P, actually, on a pretty big semiconductor name. What's great about today's session, but besides the fact that it was up over 6%, is that we have regained the 200-day moving average on a closing basis. Let's see if we can hold that. So the gap higher is great. We're gapping above the breakdown level, which is around 320. We're also closing above the 200-day. I would love to see a bit stronger momentum. Here we can see the RSI stalled out around 60, and we failed to get much above $350 for Broadcom. We're kind of heading up to that same kind of level. Let's get above 350 with an RSI above 60. That would be sort of the bullish combination here. For now, wait and see to see if there's enough upside momentum. Semiconductors are one of those bellwether groups to watch about. We talked in February about this clear bearish momentum divergence. This is one of the things that had us not super optimistic going into March. We did pull back quite a bit. This failed breakdown, I think, could end up being pretty meaningful. We had a floor around 372 or so. It was actually a pivot point. These are highs in October and December of last year. Resistance becomes support. That's called a pivot point. And then most recently, about a week ago, we closed below that pivot point, but then the next day immediately rotated higher. So we're seeing buyers once again coming in at that level. Now we're still in this moving average limbo, but we'll see if we can get above the 50-day here. RSI, again, not super bullish just yet. So interesting setup. We'll see if we can follow through. Hey, yesterday we mentioned this is a shooting star candle on the chart of Seagate after breaking out of that coil pattern today. Pretty encouraging. Now, we didn't get above the high, which is really, according to candle pattern methodology, that's what you'd really need to negate that signal. But I would say this is encouraging that we're seeing buyers coming in out of that weaker open. So for now, Seagate holding that breakout. For now, the RSI pushing above 60. I think that actually is a pretty bullish breakout, as now we confirm a break above trendline resistance and confirm a break to a new all-time high, new all-time closing high today. Plug Power was one I meant to mention yesterday, and I ran out of time for it. We have clear resistance. This is a low price stock now, right? It's down around 230, 240. This is a name I used to look at a lot more often back in the, sort of COVID Biden era, but it's chopped around quite a bit here and has been sideways for the last 3 or 4 months. We have clear resistance around 245 or so, 250. And just this week, potentially breaking out. I'd love to see if we can follow through above there. Again, it's a low price stock, so probably off the radar for a lot of investors. But I was scanning for stocks making new swing highs, and this came up, and I was intrigued. So we'll see if we can hold that breakout level, right? We've seen a couple times where we've tried to break out and have failed to hold it. That means it's not a valid breakout just yet. We'll see. All right, big bounce higher in some of the healthcare providers. This is Humana, ticker HUM. Good, a gap higher on the open on news about, related to funding for Medicare, Medicaid, something along those lines. Gapping above 190 is great. We opened all the way up here, just above 200. We traded down to that 190 level and closed up here around 197. So what's encouraging about this chart is we had resistance swing highs in February around 190. We gapped way above that. We pulled back, but found support right at that breakout level. So for me, that seems like a pretty clear level of support. That's the floor for now with the gap. We have the momentum moving quite higher. So encouraging gap if we get the follow through tomorrow. United Healthcare also with a nice move higher, closing just slightly below the 200-day moving average. We had a couple attempts to get above the 200-day that have failed. So we'll see if that can continue the movement above there. A close above the 200-day would be ideal, but same with Humana. The RSI is accelerating higher, and I think that's a good thing until proven otherwise. All right, I'm seeing some comments and discussions. Let's see. Dave, at this time, which has the highest correlation to headlines, tweets, and such? UUP or USO or Bitcoin or gold? It seems that there's a discrepancy between paper, oil, and the molecule. Ditto for gold. I mean, yeah. So which is the most? I mean, so crude oil, I would say, is most directly, connected to this. For me, is what I would say. The one that you didn't mention would be interest rates. So I would say those are the two that seem most closely aligned, right? For me, it's the crude oil, which makes direct sense, right? Because it's the supply side of crude oil is fluctuating, or the expectations are fluctuating. So that means prices going up or down based on those changing expectations. I think that's the most direct thing. We're seeing interest rates react very, very quickly. So I think the bond markets are fairly sensitive to what we're seeing there. When you think about equities, when you think about Bitcoin, when you think about gold, when you think about the dollar, I would say there's probably other things at play that are also part of those stories. So for me, in terms of like instant reaction, crude oil, and interest rates, those are the two to pay attention to, and arguably those could be the two most important things to follow here as the days and weeks and even the months go on. I would say that's probably pretty meaningful. J. Ross, thanks for watching. You had said S&P still hasn't dropped 10% since recent highs. That's a major line for me. What's interesting about that, you're not the only one to keep an eye on something like that, and I don't discount the importance of that, right? Keeping an eye on like a 10% drop from all-time highs can be helpful, because a lot of people might say, yeah, 8 to 10% drop, kind of a garden variety pullback. I have no problem with that. More than a 10% drop, people start to notice, right? Once you see your returns off the highs over 10% down, that's when it starts to feel, there's a different, that added digit in the number changes from, oh, this isn't a big deal, to, oh, this might be a big deal. And that a lot of times can motivate a new wave of selling. So I think that's when you think about when the market's moving lower like this, that's what tends to happen. A lot of times there's that feedback loop where weaker prices lead to higher fear, higher anxiety, which leads to more selling, which leads to lower prices. And so as we test, I think breaking through the 200-day was one example of that, breaking below like 10%, breaking below like a key Fibonacci level in certain circumstances. These were all things that sort of indicate, we've broken below a level where anyone that's kind of comfortable with a little drawdown is uncomfortable. None of us like a huge drawdown. It's just how much of a little drawdown we can stomach. And some people start to not be able to stomach when things rotate lower. So we shall see. Hey guys, thank you so much for watching live. Thanks for hanging with me. I think the voice hung in there okay today. I'm going to continue to rest up and try to keep going here. We'll see, TBD on my rotation down to Southeast Florida, but I'm skeptical at this point. I am hoping I have a dramatic improvement here in the next 12 hours. But in any case, thanks so much for watching. Thanks for being a follower of my work. Thanks for watching and telling others about it. It means a ton. The fact that I can do what I'm doing here from home and talk about charts and have a business built on that is a huge blessing. And I appreciate you being a part of that in some way. For Market Misbehavior, I'm Dave Keller. Have an awesome night. I'll see you tomorrow. In the meantime, remember, it's always a good time to own good charts. Take care, folks.